Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner, and founder of Menninger and Associates Financial Planning. I'm pleased to have as my guest today, Brad Sorensen, who is a chartered financial analyst, CFA. He has been on my show plenty of times. In fact, we're doing this on a quarterly basis. It just so happens that we're at the beginning of the year, so we're taking a little bit of a different tack. So Brad, thank you very much for joining me.
Great to be here as always.
So we're going to be talking about prior year, current, and the next coming year. So this represents part one of a three-part episode or series, shall I say, on this particular topic. So this represents part one of a two-part series on this topic as we present last year and an outlook for going forward. So Brad, talk to me. Beginning 2026. Let's start off by talking about what happened in 2025. We had a good year.
Well, yeah, and it was interesting because it was actually a broader good year than we've seen in the previous good years because we've had three in a row, which isn't all that often. But we had about a 17% gain on the S&P 500 for the year. But if you look at the international markets, the developed market and the emerging markets, they were up 30+%. So there's kind of a move, and part of it was the tariffs that kind of got the ball rolling for the moving some money internationally. But then the US markets also recovered. So, yeah, it was pretty much a more broad based rally for a lot of different asset classes as opposed to the previous 2 years when we saw really just seven stocks perform really well.
Right. Well, I noticed that when I take a look at the difference between the S&P 500, which was 17.88%, closer to 18, and the NASDAQ was 21, both very good years. But in the prior years, when you had those seven stocks driving it, the gap was much, much greater.
Yeah, the NASDAQ was up, in the 28-30% range, and the S&P was, and part of the reason the gap is closed is because those seven stocks make up more of the S&P 500. So the NASDAQ and the S&P 500 are now closer related, which is kind of unfortunate, but that's the way it is. And then also we've seen the Fed cut rates in 2025, which we'll talk about, but that helps small cap stocks. So we've got a range of assets that went up in 2025.
Well, so I know this is something we talk about in our meetings every week, and I believe it's the only other time in the last roughly 12 to 15 years that international outperformed the U.S. was in 2017 when international was at 38%, U.S. was 35%. But this was a big jump. But one of the things that we discussed was a lot of that had to do with the dollar dropping. The dollar dropped precipitously in the beginning of the year. And basically, if the dollar drops by 10%, just by currency exchange, international is going to outperform by 10%, right?
Exactly. There's the currency effect to international, and that's if you think the dollar is going to drop, that international stocks will benefit from that. Of course, there's more to it just because, some people think dollar drops automatically invest internationally. Well, that doesn't always correlate because just because you get the currency tailwind, they still have to perform. Their economies have to do better. Their earnings have to do better. And part of it internationally was that the expectations were so low coming out of 24 that there was a bunch of problems. I'm not going to go into them all, but in the European markets and Asian markets, and then combined with the tariffs, the dollar weakening, which tariffs contributed to, and some modestly better performance, like things couldn't get much worse, that helped international markets outperform. It's like investors suddenly remembered that there was a whole other part of the world that they could invest in.
So explain to me, why would the tariffs benefit international?
Well, initially, if it's hard to remember back to April, but when the tariffs were announced, the US markets plunged. They were down about close to 20% in April because people thought those were going to tank the economy, that we were going to go into a recession in the US, and that international markets, while still would be hurt by the tariffs because the US is the biggest market that purchases their things, their valuations were much better. And investors viewed that as a quote safer place because of the uncertainty in the US. So that helps. Now, their economies, if the tariffs had gone into full effect, their economies would have been hurt as well, and probably more than the US in actuality. But their markets were the so less valued that they didn't have as far down to go if they did have problems. And then when they realized there wasn't problems, people came back to the US but still invested internationally.
Well, that's very interesting you say that because, every month we take a look at different charts that reference the US versus international from a valuation perspective. And I believe, as I remember, was it valuations? They're at 3 standard deviations away, which means that, what is that, 99% of the time it occurs within that?
Yeah, that's exactly right. And that's what I wanted to point out really quick is that international stocks are always, almost always, I hate to say always, almost always valued at a lower valuation than the US. The US has a premium because we have the most liquid capital markets and perceived to be the safest most of the time capital markets in the world. So the US gets a premium and their stocks are usually valued at a higher valuation than international. But the valuation difference isn't 3 standard deviations like you talked about. If you look at the average deviations over the last 100 years, this spread has only happened, yeah, less than 1% of the time. So it wasn't a historical difference that valuation, we always say it's not a good timing mechanism, but over time it will revert to the mean. And that's what we had to do eventually. And there were some catalysts in early 2025 that helped that start to happen.
Well, so the fact that there's such a spread between the US and the international, is that because the US is overvalued, the international is undervalued, or probably a combination of the two, correct?
I'm going to say A and B. Yeah. And, we'll talk about valuations later. Overvalued and undervalued is somewhat of a matter of opinion, but if you look at history, PE ratios in international are a little below where they are historically, and PE ratios in the US are a little above wherever they are. So then you combine those two, and it was actually worse at the beginning of the year. It still is that case, but then you combine those two and you get a pretty wide spread to what the average spread is between those two.
Right. Well, you reference that the PE ratios are high in the US. One of the things that I recall for many years, and of course, you're the talking heads, but we're part of the same talking heads because we have those same discussions ourselves, is that they were saying, oh, well, gee, in 18, 19, 20, 21, that the high PE ratios are sustainable because of the fact that interest rates are so low. Like there is no, Tina, there is no alternative. And if they take a look at the PE ratio of the markets being 20, that means the market yield is 5%. And if bond yields are 2% or even 3%, well, that means the market yield is better than bond yield, which means stocks were underpriced, arguably. Now, yields aren't that low anymore. What's their excuse now?
Well, and that's what we'll talk about this a little bit later, but the market valuation, that's a phrase I don't like because there are different asset classes in the stock market that have different valuations, and right now there's vastly different valuations. But interest rates will, like, if interest rates go up, even now, stocks will probably go down because they'll just what you said. But the valuations are supported this time, and this is a good. There's another ratio we talk about. It's called the PEG ratio, and that introduces growth into it because investors are willing to pay more if the sales are growing at a certain rate. And that's one major difference between now and if anybody can remember way back to 1999, that the internet companies, a lot of the same hype was there that it was economy changing, that this is world changing. And it turned out to be, but that didn't mean every company was going to go up. But many of those companies weren't earning a dime. In fact, they were losing money hand over fist. Right now, these AI companies, the big ones, the ones that are leading, they're making money hand over fist. So they have the revenues to back up their valuations. And if you look at the PEG ratios compared to history, they're relatively in line and don't look overvalued at all.
So, for the sake of the viewer, PE ratio stands for the price to earnings. If a stock's price is $50 and it earns $20 a year in earnings, that means its PE ratio is 50 divided by 20, which is 2.5. And the PE ratio of the markets right now are what? Somewhere in the 20 to 22 range?
Well, again, Mike, I told you I don't like market valuations because it doesn't. Yeah, but the S&P is right around 22, 23 right now.
Right. So just trying to explain the whole PE thing. So what the PEG ratio is if a PE of a particular company is 20, but is expected to grow by 10% this year, well, then its PEG ratio is 20 divided by 10, which is 2. I actually love the PEG ratio because I think it gives a better understanding of the valuation, if you will. And I believe you said that the PEG ratio of the S&P 500 is 1.22, correct?
Yeah, right around. I mean, it changes daily, but it's yeah, right around 1.2.
Do you like the PEG ratio since you hate valuations?
I don't hate valuations. You just have to be more specific on valuations. That's the key. There's not just a market valuation. But yeah, I like the PEG ratios because I think it is a good indicator because investors are willing to pay more for growth. Now, the one caveat with the PEG ratio is it's based on estimated growth going forward. And that's always up for discussion. Like, what are the growth rates of these AI companies, and will they be able to meet the growth rates that is projected for the next 5 years to justify these PEG ratios? Now that's kind of the one tweak with this, but I do like the PEG ratios because it gives another view with valuations than just a flat PE ratio because earnings of one company aren't the same as earnings of another.
Correct. Now, let me ask you a question. When you reference the growth for the next 5 years, when they do the PEG ratio, is that anticipated annualized growth for 5 years or 1 year?
Usually they average out 5-year growth and use that number, the average growth rate expected for the next 5 years.
Really? And so that's part of the PEG ratio, even though the earnings is only for the next 12 months, they're talking about growth over 5 years.
Right.
All right. Okay. Actually, I didn't know that. I thought that
Usually there can, it depends how to do it, but usually when you see a PEG ratio, it's the average growth rate over the next 5 years.
so that's interesting because I believe the MAG 7 is a PEG of 1, which I've always known as a 1 is actually pretty good. And that helps, for a lot of people, it's like, oh my goodness, all of these AI stocks are too expensive. Their valuations are too high. Their PEs are too high. But, if a stock has a PE ratio of 30, but is expected to grow by 30%, well, it justifies it. But to your point, is it really going to sustain a 30% growth? And
Yeah. And that's where I would say that probably by my judgment, very humbly, you to combine the PE with the PEG, the PEG ratio, they probably are modestly overvalued because there's going to be more competition. There's going to be other companies entering the market. The insatiable demand for chips for AI will probably slow down some. And there is some modeling of some slowing down, but I think it usually slows down more than people think because there's a lot of optimism in the AI space right now. So I think the PEG ratio is probably a little overly optimistic, but not to the extent where the PE ratio says they're overvalued because the 7 are somewhere around 35 PE right now.
okay. Well, that's good. So, Brad, we're going to take a short break here and stay tuned. We'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger and Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back. Thank you for joining us. And Brad, we're going to pick up we were talking about PEG ratio at the end. One of the things that we were referencing most notably was the AI stocks, the Mag 7. Okay. And again, we're not here to promote any particular stocks, but it's the 7 stocks that are very heavily affiliated with AI, the Apple, the Microsoft, the Amazon, the Nvidia, the Tesla, the Google, and Meta. Okay, there's my 7. It's probably the best I ever did whipping them out. I always seem to forget 1 or 2 of them, but be that as it may, one of the things I want to go back to with the PEG is referencing growth. And this is something that you've been talking about for quite some time, is that there's a concern that they're not going to have that level of growth, that investors are becoming concerned with the AI companies spending all of this money, but not really showing the revenue for it. Can you talk us through that a little bit?
Yeah, of course. And we actually started to see that at the end of 25, where certain companies would announce new capital spending or different capital spending, increased capital spending, more data centers, those kind of things, buying more chips. And the market didn't reward that. Usually earlier, they'd just go, oh, great, you're building more. That means you're going to get more revenue. You're going to do. But we haven't seen a lot of those revenues come through yet. Now we will. Um, I'll just go back to the internet era really quick. If you remember back then, it was Cisco that was kind of the Nvidia of they provided the chips and the backbone, and people thought they were going to go on forever. Well, eventually we're going to have enough chips and there's going to be competition, and other companies are going to build chips that are good enough to use, and the prices are going to come down, and Nvidia is not going to be able to sell at the rate they are. So the growth rate, that's just one example. I'm not talking about any particular stock, but I'm just saying the companies, their growth rate is going to decline because that's what capitalism does. You get competition, you get other entrants, you get lower prices. And that's what happened in the internet era. Was Cisco continued to sell chips, but other entrants came in. There was a satiated supply. And also analogous is there were winners and there will be winners in this AI space, but then the investors started to pick and choose and realize that not everybody was going to be a winner, and that'll happen this time too. That not all these AI companies are going to continue to grow at this rate. There's going to be some that do better and some that do worse, and that's where investors are starting to make those determinations now, which is good to see.
Well, it's funny. I remember you said in one of your weekly recaps, you had sent something that showed how they're all integrated with each other. You know, Nvidia is investing in Microsoft, who's investing in Apple, who's investing in Amazon, and they're all, and I just picked those names, but they're all investing in each other. It's no wonder why they're all making money, because they're all spending money on each other.
And that's what started to, I think, concern some investors that the spending can't keep up. And some boards have mentioned we can't keep spending this money. We need to start to see more revenues come in to support it. And yeah, you see, especially, well, we won't go into specifics, but yeah, there was a lot of inter-investing, and that's not what you like to see. You want to see outside investors bringing money into the group. And we see a lot of that. But in order to keep the growth rate up, they're kind of investing in each other, and that can't continue.
So I like to bring this up from the perspective of lay the foundation. I don't know if it was when Facebook first went public, but I remember it went public and someone asked me, hey, should we invest in Facebook? I'm like, Facebook is a wonderful thing. You can go online and connect with friends that you haven't seen from high school for 25 years, and you can chit chat, or you can see what your neighbors are doing and your friends are doing, but how does it make money? And I wasn't a believer in it in the beginning until they figured out how to make money through advertising. So I now parlay that into the whole AI story. I could see them doing the same thing. Hey, you want Chat GPT? Great. We're going to charge you a subscription for it, or something like that. I do understand that the biotech and the pharma industry, I don't know about pharma necessarily, but they use AI because it enables them to process lots and lots of data much faster. But can you give some examples to the viewers as to how AI can and probably will make money?
Sure. Well, I think we can go back to, because everybody can look back and see how the internet, and this is the best example I can think of, that there are internet companies that did well, like Google, for example. They ran search, they sell ads, they basically made their money on the internet. Now they're involved in other things, but that's how they made their money on the internet, off of those ads. And there will be AI companies that do that, whether it's, yeah, Chat GBT, Gemini, those kind of companies are supported by larger companies. But, you know, the dominant open AI, the web source searching, they'll be able to do that. And there's other opportunities. But then it's using the AI to make money. We can go back to, I think the better example is, whoever thought a online bookstore would be one of the most valuable companies in the world. Well, I don't know if anybody knows this, but that's what Amazon started out as when I was in the business way long ago. It was just an online bookstore. You could buy books. Well, now you look at it, it's the major retailer in the United States. They've used the internet to make them what they are. And some companies, and that's the fun part, is trying to figure out those companies who's going to use the AI to develop whole new businesses and whole new ways of doing business and whole new products and new consumer interface ideas and all of that. And that will also make money. And then there'll be whole branches off of that. So, yeah, it's very exciting. And it's not just going to be these 7 stocks, and investors are realizing that now.
I'd heard someone had come in talking to us about how Costco uses AI. And what they're able to do is to identify somehow, some way, all of the data of the consumers that allows them, and I'm surprised that nobody's figured this out before, and that supposedly has a lot to do with why the Costco stock had performed well. And again, I'm not here to recommend stocks. I'm only here to use companies as examples. But what they were able to do is to be able to take all of the data from the consumers that are going into the stores to better identify location within the store to put stuff, what they're going to sell. And this store over here may be selling a lot of this, but that store over there isn't. And they're able to use the data to enhance the amount of money that they make from their sales. And I can't imagine that Walmart's not doing the same thing. I'm just trying to think of all the different potential uses. So you figure, let's say Costco's doing that, and are they buying the AI from these companies?
Mostly what people do is they buy the AI and then they develop add on to it to their specific needs. They buy the base program and the open AI infrastructure that they need, and then they can tweak it and have people in their companies, especially the size of a Costco and Walmart, that can tweak that information and the code within the AI and how it's reading things and what it looks for to fit their situation. Now, I do want to mention one thing, and you brought it up great. AI, this, you sound like the typical, hey, AI, nothing but great stuff. There are some problems, and we've already started to see them, that you just said. Costco's, well, they don't have to have employees go through all that data anymore. Amazon, there's a warehouse near me. They used to have 3,000 employees that move stuff on the floor. Now they have 3 because AI robots do everything else. So that's going to be the question. How much does it impact the employment market in the US? Because to spend on all this AI stuff, you need the consumer to continue. And the consumer to continue, you need the jobs. So I'm not saying it's a problem. It's something to watch, though. Everybody thinks, oh, AI is going to revolutionize the workforce. Well, it might. And I think in some cases it will, but there's going to be some friction there as those employees need to learn new skills.
Right. Well, guess what? And not only that, but to your point that we've said before, you got the robots now with the AI robots. Somebody needs to develop the robot. Somebody needs to service the robot. Somebody needs to build it. And so what you might find with this type of thing is a tectonic shift in the labor market where people are doing different things now.
Yeah, and that's what we've seen with this is another, there's the industrial revolution, then there's the internet, and this is probably another one of those major shifts. And at each of those, there was the gears grind at the beginning. At the end of it, it usually ends up in more productivity, more efficiency, more jobs, even. But the people caught up in it, they have to get retrained, new jobs, and that just can cause some friction in the economy.
So another thing that happened in 2025, and I'll come to the 800-pound gorilla in a few moments, is the Fed is now cutting interest rates. It raised interest rates very quickly in 2022, which destroyed both the bond markets and the stock market. In fact, the irony of it is that the 5 years for bonds still have not yet broken above the black line. Okay. They're still in the red for 5 years, which is pathetic. They're getting there. They're getting there. But the Fed cut interest rates, and that is, which will lead into next episodes about the whole Fed, because it's working its way into 2026, a new Fed chair and all that fun stuff. There's lots of stuff, but the Fed is now cutting interest rates.
The Fed has cut interest rates.
That's what I meant. It cut 3 times. Right.
Yeah, in 2025,
right.
It did. We had 3 cuts, 3 in a row at the end of the year, and inflation isn't still where they want it, but they thought it was on the right trajectory, and they started to get worried apparently about the employment market, and we have seen unemployment tick up a little bit, but it still looks pretty healthy. So what the most interesting thing, and we'll talk about this more in the next episode, was that this is the cuts happened, but it was one of the most divided Feds that we've seen in a long time.
Interestingly enough, everybody also says, oh, they're cutting interest rates. That means immediately mortgage rates go down. And what they don't recognize is that there's not a direct correlation between the two. In fact, they cut interest rates 3 times, meaning 0.75%. The 10-year Treasury, which is the foundation that they use for interest rates, didn't move. And I think after one of the cuts, the 10-year went up. So
yeah, that's and I understand people don't follow the Fed day to day and know all the intricacies because it gets very boring. But yeah, they affect very, very short-term interest rates. Now, the signals they send, and by doing that, sometimes that can affect the longer-term rates, but it doesn't always. And we saw that this year, that it didn't really affect the longer-term rates.
So, I think that would have been a good one to have as a transition into the next episode. The other thing that happened was in all of October into November, we had what? 39.
Well, we had the government shutdown.
Right.
And nobody cared except for the people that were working, but we got a data cave that we didn't get any data. So that was a little frustrating for investors. And to make everybody happy, we could have another one starting at the end of January. So things looked really good with the government, but they figured it out, at least as they always do. And that's what investors knew would happen. So the market really didn't, government shutdowns really don't affect the stock market very much.
Apparently not, because it didn't seem to move one direction or another. And, it always makes me wonder, they shut down the government for 6 weeks. Everybody goes home for 6 weeks, and then they come back and they get paid for 6 weeks, 6 weeks paid vacation.
Yep.
Why did they bother? What did it accomplish? Other than those employees were struggling for 6 weeks to how do they put food on the table if they're living paycheck to paycheck. I just never fully understood it. And the shame of it is Congress is using government employees as pawns for one side against the other.
Well, and tune in for the next episode because the reason behind the government shutdown is much more interesting than the actual government shutdown, and they didn't solve that, and that could cause some problems in 2026.
That is correct. And not only that, it could cause problems in 26, 28, 30, 35, and 40. So that's a great, and I know exactly where you're going with that. And that's a great opportunity for us to call it quits for the end of this episode. What we're going to do is we're going to pick up next week with talking about kind of transitioning from that, the government shutdown, et cetera, into current. And then we're going to talk in the following episode where we're going from here. So thank you very much for joining us, and we'll be back with you next week. You have a wonderful day and a wonderful week. Thank you.